For decades, one country has quietly been the secret engine of the global financial system, not because of its stock market or its economic power, but because of one simple, undeniable fact. Money in Japan was basically free. While central banks around the world were raising interest rates to fight inflation, the Bank of Japan held firm, keeping its rates pinned near zero. This decision turned the Japanese yen into the cheapest currency on earth to borrow. Think about that for a second. While everyone else was paying more for money, Japan was giving it away. Over time, this created a massive, silent dependency. Investors, hedge funds, banks, and even entire governments came to rely on this endless river of cheap yen liquidity. This phenomenon has a name: the yen carry trade, and it's one of the most powerful, yet least understood, forces in modern finance. The logic is simple, but incredibly potent. An investor borrows huge sums of yen at an almost 0% interest rate. They then convert that yen into another currency, like the US dollar, and invest it in something that offers a higher return. This could be anything: American stocks, European bonds, real estate in booming cities, private equity deals, even crypto. The difference between the high return they earn and the near zero cost of borrowing is pure profit. For years, this trade was a money-making machine, fueling asset bubbles all across the globe. It worked flawlessly, so flawlessly, in fact, that the world got addicted to it. This constant flow of cheap Japanese capital pushed asset prices higher and higher. It was a silent fuel behind the longest bull market in history. But now, the music is about to stop. The rules of the game are changing. After decades of near zero rates, the Bank of Japan is finally starting to raise them. A small change, you might think. But in a system built on a foundation of free money, even a tiny increase is like an earthquake. Suddenly, borrowing yen isn't free anymore. It's becoming more expensive. And that tiny crack in the foundation of global leverage is starting to spread. Investors who built their fortunes on the carry trade are now facing a terrifying new reality. Their borrowing costs are rising. The profit they were making is shrinking, or even turning into a loss. They are being forced to unwind their positions, not because they want to, but because they have to. This isn't a strategic retreat, it's a frantic rush for the exit. And this triggers a brutal chain reaction. To close out a yen carry trade, an investor has to do two things: sell the global assets they bought, and then use the proceeds to buy back the yen they originally borrowed. Now, imagine millions of investors all trying to do this at the same time. The result is a tsunami of selling pressure that hits every market simultaneously. Stocks start to fall, bond prices drop, volatility spikes through the roof, and liquidity, the lifeblood of markets, simply vanishes. The very first place you see the stress is in the currency markets. As investors scramble to buy back yen, its value skyrockets. For anyone who borrowed in yen but holds assets priced in dollars or euros, this is a nightmare. The stronger the yen gets, the more it costs them to repay their loan. Every tick up in the yen's value is another turn of the screw, amplifying their losses and increasing the pressure to sell everything and get out. Emerging markets are often the first victims. These economies, which once benefited from the flood of cheap capital, now watch it rush out just as quickly. As foreign investors sell local assets and flee, their currencies collapse. A weaker currency means imports become more expensive, fueling inflation. This forces their central banks to raise interest rates to defend their currency, even if their economy is already weak and struggling. This is how a single policy decision made in Tokyo can send shockwaves through entire continents, pushing fragile economies to the brink. Next, the contagion spreads to the stock market. As investors get margin calls and are desperate for cash, they sell what they can sell quickly. Stocks, the first to go, are the high-growth, speculative names, the tech companies and startups that were the biggest beneficiaries of the easy money era. Their entire business models were often built on the assumption of cheap, abundant capital. When that disappears, their valuations crumble. If you look back through history, you will see a clear pattern. Periods of a strong yen almost always coincide with major stock market corrections. This is not a coincidence. It is the direct, mechanical result of the global carry trade unwinding. And it doesn't just affect a few markets. US stocks, European equities, and global indices all feel the pull. When a liquidity crisis hits, all correlations go to one. Diversification fails when you need it most. Everything falls together, but the impact doesn't stop there. Japan isn't just a source of borrowed money. It's also one of the world's biggest creditors. Japanese institutions, like pension funds and insurance companies, own a staggering amount of foreign debt, including trillions of dollars in US Treasury bonds. For years, with interest rates at home near zero, it made sense for them to send their money abroad in search of higher yields. But now, As Japanese interest rates begin to rise, that incentive is fading. Why take risks in foreign markets when you can finally get a decent return safely at home? So, capital begins to flow back to Japan. This means Japanese institutions stop buying US treasuries and other foreign bonds, and in some cases, they start selling what they already own. This reduced demand for bonds pushes their prices down and their yields up all around the world. Suddenly, borrowing costs for governments and corporations everywhere start to climb, even without their own central banks doing anything. The Bank of Japan is effectively tightening financial conditions for the entire planet. And what about the most risk-sensitive asset class of them all? Crypto markets are the ultimate product of global liquidity. During the era of easy money, when cash was flowing freely, crypto thrived. It was the perfect speculation for a world awash in capital. But when liquidity tightens, the reverse happens with brutal speed. If higher Japanese rates trigger a global risk-off event, where investors dump anything perceived as risky, crypto markets will be at the epicenter of the storm. We've seen it before. Bitcoin often leads the way down, followed by even more severe losses in altcoins. This doesn't mean the end of crypto, but it serves as a harsh reminder that even a decentralized market is deeply connected to the old world plumbing of global liquidity. Every major financial shock in history has followed the same script. First, excess leverage builds up quietly, hidden in plain sight. Risk is systematically ignored. Confidence turns into complacency. And then, a small catalyst shifts the conditions, and the whole structure unwinds faster than anyone thought possible. The real danger here is not a single rate hike from Japan. The danger is the timing. The Bank of Japan is tightening policy at a moment when global debt is at record highs, when asset prices are still stretched, and when other major central banks are already keeping money tight. The system is loaded with leverage and has no shock absorbers left. This is when things can break. Margin calls start to cascade. Forced liquidations create a domino effect. What began as a routine policy adjustment in Tokyo morphs into a full-blown global crisis. Japan may seem far away from the daily market headlines, but for decades, it has been supplying the high-octane fuel that kept the global market engine running smoothly. Now, that fuel supply is being choked off. A rate hike by the Bank of Japan is not just a domestic policy decision. It is a global liquidity event, one that hits currencies, stocks, bonds, crypto, and emerging markets all at once. Markets don't fear change. They fear sudden, unexpected change. And for the past 30 years, the world has been conditioned to a stable, unchanging Japan. When that anchor finally moves, the entire world moves with it. Understanding this dynamic isn't about trying to predict the future down to the day. It's about recognizing where the real systemic risks are hiding. They're not in the screaming headlines. They're in the hidden mechanics of global finance. Because the biggest shocks are never caused by what everyone is watching. They are caused by what everyone forgot to watch. Thanks for watching. If you found this explanation helpful, do you not forget to like this video and subscribe to the channel for more deep dives into how the world of money really works. See you next time.